Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral, Dadia. We have with us Saugata Bhattacharya, Chief Economist, Axis Bank, joining in. Saugata, good to see you. A very warm welcome.
Thank you.
My first question coming to you over here is, overall, I mean, we've spoken enough right now with regards to what's been the impact with regards to COVID-19 on the economy. The next step that everyone has been talking about is the stimulus that was announced by the government. And now what we need to understand from here on is that are the measures that have been announced by the government as well as the RBI, do you think they have been enough?
So again, thank you very much for having me on your show. I've been a huge privilege. Thank you. So let's start with the economic situation, the growth situation, because that will give you an idea, a perspective on the adequacy or lack of the government measures, of the stimulus, RBI and government stimulus measures. So even now, this given the uncertainty of the ongoing healthcare crisis, it's still very difficult to take a call on how much might be the growth slowdown. So we are still keeping it at about -4%. That's the real growth. But even more worrying than that, because of the drop in commodities prices, other prices, I think we'll easily see a nominal growth of anywhere between -1% and -1.5, maybe a little bit lower. So that means a straight off income loss of anywhere between 20 to 25 lakh crores. That's a huge number. Remember that our GDP last year, FY20, was about 210 lakh crores, of which 10% has just been wiped out. So the measures that have been taken originally with the Reserve Bank of India, then progressively with the government, needs to be seen in this context. So again, the top headline numbers is again the 10% of GDP, the 20 lakh crores that we hear about. But as we all know, a large part of that 8 to 8.5 lakh crores is RBI's own monetary policy stimulus, and then another 3 lakh crores or thereabouts. Many people say that it's lower. It's really difficult to take a call because a lot of the fiscal measures that have been announced might essentially be pulling forward of income expenditure planned later in the year, some mixing and matching of headline schemes that have been announced in the budget, expenditure schemes and programs. So it's really difficult to take a call. Let's say it's about 3 lakh crores, which is about 1.5% of GDP. The rest are predicated on various kinds of backstops, support, and measures to incentivize credit to various segments of the economy. So that's the scope of the package. Let's talk about how much this can actually help in plugging part of the income loss that we see in the system.
Right. So with this, as we just did this number crunching, now the biggest question was that the stimulus has been more on the credit side of it versus the fiscal side. Do you think this would be enough to revive the economy? Because, or do you think some more on the fiscal side is something which is still required?
So, as you said, a large part of this is predicated on credit flows coming into SMEs, into real estate, some of the other segments. As of now, the numbers that we have seen still suggest that there has been an increase in credit flows, no doubt about it. The latest numbers that we have seen. But bank credit growth overall still remains 6.2%, relatively low. There have been some NBFC lines that have been given and which is being on-lent onto the system. But overall, the degree, the extent of risk aversion that we had seen coming in largely from H2 and particularly in Q4 of FY20, that still persists. That doesn't seem to have dissipated together with all the other measures. All the other incentives, the refinancing, the backstops, the guarantees still hasn't done. Maybe it will. I'm sure banks are now in the process of understanding the guarantee schemes. The guarantee schemes are getting clarifications. Some of the measures that have been suggested to the government are being put in place. So maybe there'll be an increase in credit. But overall, I mean, in a situation where there is this extent of demand destruction, although I completely understand that this is a supply shock, this is not, but the secondary, tertiary demand destruction that has happened will probably need to be plugged in by the only source. Remember, the government and the RBI that can print money in the system to be able to take out part of the income loss that has come in. Hiral, I like to think of this current problem as an unusual confluence of four C's: credit, COVID, crude, and confidence. Now, of course, there's a fifth C, China. But we'll leave that aside for the time being. Confidence, I think, amongst the others, has been one of the key manifestations of some of the demand issues that we are seeing in the system, the lack of demand. And this confidence can only be partially, at least for the near term, 2, 3, 4 months. For the near term, this confidence can only be brought back in by renewed spending with the government. I completely understand. I mean, it's very easy for me to sit over here and say that, hey, the government should spend more. I mean, given the paucity of resources that we have seen in the tax collections in the first 2 months of the year, and also probably the advance taxes that have been paid in the middle of June, corporate advance taxes, that obviously there is a huge problem in terms of receipts. So the government has to spend more through borrowed funds. How much of this can the government take on its own using some of the reserves and so on, and how much of it can be supported by the Reserve Bank of India through various measures now needs to be seen.
Right. So with this, if everything is done right, what is the kind of shape of recovery are you envisaging from here on?
You're talking about the shape of the recovery
Yes.
that we are likely to see. Well,
Correct.
I mean, our own. I mean, most of the analyst fraternity, the multilateral agencies, etc., predict a very strong growth recovery in FY22. There are some outliers who predict continuing negative growth even in FY22. My own sense is that you'll probably see some degree of recovery. But I mean, the extent of the loss that you've seen, this sharp drop that you see in all indicators in March, April, and then with a little bit of recovery in May, it'll take a fair bit of time to get up to even the March 20 pre-COVID levels. So it's unlikely that there will be very large spending impulses that come in from corporates. Remember, from the corporate side, you remember the RBI capacity utilization survey that they do. The last set of numbers that I've seen in December, as of Q3 of FY20, that showed a very sharp decline from about a 72, 73% down to about 65% in December. Imagine what the situation would be like in Q4 and then in Q1. So given this, that this excess capacity that has built up in the system in the face of relatively subdued demand, because I'm sure there are a lot of service economy, service segments which are unlikely to come up to speed given fears of infection, etc., for a while. So my sense is for this year, for FY21, given the 32% contraction that we are likely to read about in Q1, that we are probably the minus 4% that we talk about for this year. So Q3 onwards, we'll probably see some expansion from the FY20 levels. But overall, it's likely to be a very, very, very slow recovery. So it's like the, what is it called? The check mark, the check recovery. So I mean, it's a very sharp drop, then a small move upwards. But then, I mean, if some of the policies, etc., the reform measures, the ability to attract foreign investment into projects, increase in capex order books, etc., if that actually happens, then it's likely that in FY22 next year, starting from Q3, Q4 of this year itself, that we'll probably get up to a growth rate of 4, 4.5, 5, maybe higher, depending on the policy.
Right. Saugata, let me play a devil's advocate here, because all of us have been talking about that, okay, now that the lockdown has been lifted, things have kick-started to some extent. In fact, majority of the industries have already reached that 50 to 70% capacity utilization, if you have to see from the manufacturing perspective. But the, the, the other question arises over here is that the real growth is going to be visible only when companies actually start giving out results with regard to the September quarter, because that will actually give you as to how good is the demand pickup that's happening. So do you think we could play a devil's advocate over here and say that the economy probably could be in a tailspin, and we could probably be looking at something that could be worse than a recession then?
Yes, no, I completely hear you. I couldn't have put it better myself. I mean, the level of the clarity that you bring to your thinking, it is perfectly likely. So right now, what we do is now with this data that is now available. I mean, not fully available. I wish we had the data that is available in the US, and you are seeing US now casting real time almost. But we now have access to some information. Electricity, for instance, is available in almost real time. So the last data that I've seen is June 22nd. Google mobility reports in various categories. These are now available. I mean, in the major centers, the states and centers that have been hit the hardest with the COVID lockdowns, the amount of recoveries that we are seeing in travel, it's actually quite frightening. The amount of information that Google obviously now has on our habits. So travel from away from home into work, travel to retail stores, travel to grocery stores, travel to pharma and entertainment, etc. It does seem that we are in some in eastern states, we are now crossed the pre-COVID situation. All the other company results, I mean, all we are now, we look at the casual checks, channel checks, etc., to get a sense, anecdotal feel for where demand is. We're talking to industry associations to figure out where their members are, etc. So those, particularly the MSME segment, that's the real worry. I mean, because that's a large part of the segment across the board. The small companies, mid companies, large corporates, everyone has been affected. But the mid and the large corporates still have some cash reserves, which will give them a buffer for economic activity and will keep them going. I mean, it will not become a solvency issue. But for the micro and the small, unless they get access to credit, that has become a real problem. And what you were saying, that this is likely to be worse. I mean, we need to err on the side of caution, on the side of pessimism, because the buffers that the small companies have has probably already been wiped out. So unless cash gets infused into these companies in a systematic and sustained manner, my sense is that our minus 4% is likely to be overshot.
Right. And with this, Saugata, what's the kind of threshold level of fiscal deficit that you are factoring in probably that could actually get, your ratings some kinds of jitters?
So again, talking to the ratings agencies, analysts themselves. So first, I mean, our expectations. A 3.5% budgeted deficit for the center and a 3% budget for state, 6.5%. So given our expectations of revenue loss, receipts loss, tax receipts, direct, indirect taxes, dividend losses, disinvestment losses, etc., we think that the center's fiscal deficit will slip by about another 3 to 3.5%. So another 5 to 5.5 to 6 lakh crores will be the center slippage. Another, say, 1.5 lakhs, another 1% or 1.5% from the states. So from a 6.5%, we are easily into double digits. And that's without any spending, remember. This is just the revenue loss, the receipts losses for the center and the states. Our sense is that the ratings agencies feel, although we have had one ratings agency already come in with a revised outlook, not a ratings change, but a revised look. On India, on the sovereign India. So the fear of the ratings agency is that without an active government intervention, the growth slowdown. Remember, India's ratings have been predicated on sustained high growth. So if we lose the growth momentum, I think that's a bigger danger for India at this point in time, from a ratings perspective.
Hmm.
But having said this, that ratings agencies will still probably consider, and this has happened all across the world. It's not just India. Every country
Right.
has had a massive fiscal stimulus. So given this, how targeted some of these additional spends are, and what kind of plans the government has, center and the states, to get out onto the path of fiscal consolidation over the next 2, 3, 4 years, I think is going to determine the outlook, India's sovereign ratings outlook. So my sense is, I can understand from the government's point of view that they're still keeping some part of their limited powder dry. So some of the buffers and reserves that the government center and the states have, in case things become worse, I mean, those are to be kept aside for them to tap at some point in time. But I think as of this point in time, and this is only possible through Reserve Bank of India support. So my sense is that the government and the Reserve Bank should try to push a little bit on the envelope of the spending and the stimulus programs that they had, to try to see if they can get a growth revival quicker.
Right. So what's your opinion then with regards to where the direct monetization of the fiscal deficit by the RBI goes? Do you think that the RBI will have to directly then monetize the government debt as well, given that the state and the states have put together? I mean, their borrowing limit has gone up as well. So, is there a direct monetization plan that could be used, and will that actually put any red flags on the rating agencies then?
So I think it now is becoming clear that the Reserve Bank of India will have to provide some support to the government's borrowing program, whether through secondary operations, market operations, or through, as you said, direct primary, absorbing the primary issuances of the government. Look, in actual terms, there is really no difference between secondary market, OMO, and other operations and primary market issuance. It's the same. The money that comes in into the system is about the same. The increase in the RBI's balance sheet remains the same. It's just a perception that old nasty ways that used to happen in India in the 1990s, with the ad hoc bills and on-tap issuances of ad hoc T-bills to monetize the government. So that stigma of those types of operations is the only part in terms of a direct versus a secondary market operations. Otherwise, there is no real difference in terms of both supporting the borrowing program and trying to control the shape of the yield curve, whichever way that works. But beyond a certain point, it begins to become a problem. One of the key reasons why India still has or has had, I mean, apart from its growth potential, an investment grade rating is the balance sheet composition of the Reserve Bank. So given our 30% of our assets are domestic assets, which have a triple B minus investment, the lowest investment rating, and the rest of the 65-70% are foreign currency assets, which either have a triple A or a double A rating associated with it. So effectively, the Reserve Bank's balance sheet in foreign currency terms is actually much beyond the government's local currency sovereign rating. So that's one key constraint that a ratings agency will see in terms of what kind of risks might be building up in the Reserve Bank's assets, in the holdings of their assets and the composition of their assets. So other than that, I mean, the fear that India's debt to GDP, and remember, all of this is local currency debt. So there's no real fear of any significant default. The government can monetize and print money and it just leads to other macroeconomic problems, imbalances, and so on. But there's no fear of a default in domestic currency terms, in local currency terms. So otherwise, it remains fine. The other constraint, of course, is inflation. That too much of monetization, too much of spending, given the fact that much of production still remains muted, is likely to lead to higher inflation. So something which we have fought long and hard and has come down to the inflation targeting levels, etc. A long, hard-fought battle. I mean, that will go to naught again, and the Reserve Bank will have to take measures to go opposite the accommodative stance and accommodative measures that it's done. My own sense is, given global deflation fears, although oil has also come back up again significantly, global commodities prices are also going up. So given this, fears of inflation at this point in time in India probably are not a binding constraint on monetization and the consequent infusion of liquidity in the system. I think that can be arranged for some time. And if necessary, I mean, if inflation really flares up, demand comes back faster than we anticipated at any point in time, then they can reverse, they can pull back the liquidity, etc. The government can absorb, I mean, much of the WMA, CMBs, etc. That happens. Much of that can be taken to the right side of the government's and the Reserve Bank balance. So my guess is that maybe at this point in time, the Reserve Bank has some room, of course, not an infinite room. I mean, given our high debt to GDP numbers anyway, I think the RBI has some room to support the government's monetization program. I'm so sorry, I took up so much longer than I thought that I would.
I mean, no, that was an in-depth answer, which really made a lot of sense to us over here. But with this, as we're talking about the RBI, an interesting picture is that the RBI actually acted faster than anticipated, and that was something which was done really well in terms of the rate cuts on both ends. Now, if you look at the repo rate, this is the lowest on record that we have, and we've not seen such downward revisions back then since 2008, 2009. I think if I'm not mistaken, Governor Subbarao was the one who actually brought down the repo rate from 9% in September 2008 to almost a 4.75% in April 2009. So if you see that quantum of rate cuts, do you think the RBI has further room, if required, to infuse that kind of liquidity with regards to rate cuts?
So no, fine. I mean, absolutely, I get you. So I mean, the amount of, I mean, the absolute amount of reduction has been smaller. I mean, back then it was 9 to 4.75, okay. And at that point in time it was almost precipitous, like this. It cut within 4 or 5 months. This time around, it's been a lot flatter. So that's, but of course, I mean, the repo rate now is much lower than what the lowest that it was in the GFC crisis. Of course, inflation is lower, so they have the room to do this. So this is this is an interesting question that what, in terms of what we see now in global central banks, what is the effective lower bound, the ELBs, as they are called, for India? Can the Reserve Bank of India, if it were so in the so inclined, take the repo rate down to zero? Can they? Probably not. I have in my own sense is we are already fairly close to the ELB. Maybe 3.75, maybe, I mean, if you really stretch it, 3.5, etc., but not much more than that. The reason being, India is a very deposit-centric system. Our financial savings, which is yet one of the other reasons why we enjoyed an investment-grade credit rating, is still one of the higher ones amongst our emerging markets. Not the highest, but still among the higher ones. In the absence of good remunerative rates, because remember, this new transmission mechanism in place, the market benchmark lending, MCLR, etc., and the Reserve Bank itself indicates that there's been a very sharp drop in the weighted average lending rates of fresh loans in the system. So to banks, beyond a certain point, will not be able to pass on the cuts in the lending rates to deposit rates. As a consequence of which, there will be massive pressures on bank NIMs, bank return on equity, return on capital, etc. So that might create some degree of instability. Because remember, in a credit-intensive stimulus strategy, banks need access to capital. As you're seeing, I mean, liquidity has actually come down, but together with this, the real problem for bank lending now is not so much liquidity as it's capital. And if banks have a loss of profitability, that fails to add to the capital that is needed for growth, besides the other capital that needs to be put in for the public sector banks. So beyond a certain point, banks will not be able to sacrifice profitability. Beyond which, in terms of the broader savings and capital environment, I have no doubt that beyond the point when you cut rates, there is likely to be a capital flight of foreign capital, foreign currency investors, which is something which you do not want at this point in time. RBI, I know, has sufficient reserves to be able to push back against a fall in the currency following capital outflows. But that's something which is a worry. I mean, you do not want volatility in your foreign currency markets and in all financial markets in general, as will happen. So beyond a certain point in a deposit-centric banking system, financial system, the ability to cut rates too much, I think, is limited. So other unconventional measures, all the LTROs, TLTROs, yield curve control, etc., will have to take center stage, not a repo rate.
Right. So, from the banking perspective, Shokta, what's the sense that you're picking up, especially if you have to look at the credit growth right now? What's the outlook on that front, especially if you have to talk from the retail credit growth perspective?
So, in terms of credit growth, our forecast as of now for this year, credit growth, bank credit growth will be about 5.5 to maybe 6% odd. There will definitely be a demand for working capital credit. I don't see a significant amount of demand for term loans because one, I think there will not be a huge amount of capex proposals that will come in till the uncertainty gets cleared out. Uncertainty, the health uncertainty, other in cash flows uncertainties begin to get cleared out. So I don't think there will be a significant demand for term loans overall. This is for the corporate loan. There will be a demand for supply chain and working capital finance, distributorships, dealerships, because of the lack of cash flows, will come to banks. But given the risk systems and which need to be put in place, because I mean, to avoid a situation of financial instability, you need to have very tough risk controls in the banking lending system. So, I mean, from the corporate side, it's unlikely that it will be a very large increase in credit. From the retail side, moreover, I think banks will still, I mean, the last set of numbers that I've seen for April, retail growth is still remains strong. I mean, it's come down completely compared to what we had seen in the last couple of years. But even there, I mean, given the fears of cash flow losses, balance sheet impairments, in the job losses, etc., the uncertainties that are likely to emerge, even in the employment space, I think banks will tighten their risk control measures. The scorecards will get tightened, and banks will prefer to lend to customers which banks are familiar with, the salary employees, salary guys, people who have been in a lot of the MSMEs who are proxies for retail, who have good collateral, who have good payment behavior, etc. But banks obviously, naturally, are likely to be a little bit cautious on the broader set of retail. And the more aggressive lending that we had seen via lending from NBFCs to retail, so banks lending to NBFCs, which then on lend to retail. So then, there's likely to be some break on retail lending to those segments of retail. Overall, it will not be. I mean, I'm still sure it will be in the double-digit growth. It will not fall to single digits. But my sense is retail growth, which is for the banking sector now almost 40% now of the total loan book, and incremental growth is even higher. So that probably is not likely to be as big a driver of retail growth, which is precisely the reason that we think from the 6.2% growth that we had last year, growth this year is likely to be lower at 5.5%.
Right. Absolutely. And a trend that I've picked up, Saugata, on this front, especially on the consumer financing side of businesses, that majority of the consumer financing guys have stopped onboarding new customers. And this is something which I picked up is pretty much on ground because I visited one of the Croma stores, and that's how I tried finding out from them. Bajaj Finance, or you name any of them, they've stopped onboarding new customers completely right now. So that gives you a sense as to what's happening on the retail side of it as well, especially from the NBFCs to the retail guys. But with this, if we're talking about the urban side, and if you have to compare it to rural, now the anticipation is that rural growth is going to be way faster. Touch wood that at least rural India has not been that impacted, at least on the back of the healthcare pandemic. Now, do you think the trend with regards to rural credit growth is something which could be better than urban?
Well, I mean, for one part, a lot of a rural credit, which comes into the purview of the priority sector loans, the PSL portfolio of banks. So those till now have grown a little bit slower than overall credit because banks need to maintain that share of PSL to overall credit loans. I completely agree with you that not just from rural lending, say lending to two-wheelers, etc., in the rural areas, with some support from the corporates, the OEMs, etc. So it is likely tractor loans, two-wheeler loans, etc., are likely to be to be doing better than definitely urban areas, and maybe even compared to what happened last year. So there is some products and segments of rural lending that might actually happen. Loans against gold for NBFCs might actually also pick up. I mean, so that's probably the case. In other terms, I think now if you're seeing a concerted reform push on the rural segment, particularly farm, the food processing segment, the farm gate segments, etc. So that might open significant opportunities for new capex and consequently lending, because there will be some backing of large corporates in all of this. So it is, I think you're absolutely right that not just from a retail perspective, and remember that if this capex is happening in the rural areas, that's a sure sign of increased incomes, and that will, on a secondary, tertiary basis, also lend more weight to rural lending. But I think overall, rural lending, I don't know how much will be better than urban or versus, but rural lending definitely in FY21 will be one of the key drivers of credit growth, even at that lower level, and will certainly likely to be better than urban lending, particularly on the retail side.
Right. And with this, the way the US Federal Reserve has been buying commercial paper, do you think there is a possibility or there should be something where the RBI should step in on the corporate side?
So another interesting question. I mean, so RBI currently is not permitted, statutorily, it is not permitted to buy credit. That is to say, non-SLR. It is permitted to buy SDL, state government bonds. It still isn't buying. It doesn't go OMOs in SDLs. But it's permitted to buy, but it's not permitted to buy by law corporate paper. Should the government change by an ordinance or by law, permit the Reserve Bank, facilitate the Reserve Bank, the ultimate decision is the Reserve Bank's, facilitate the Reserve Bank in buying corporate paper? There are pluses and minuses. I mean, it's not an easy question to answer. Globally, all banks, the ECB has done this, the Federal Reserve is picking up commercial paper, etc. My own sense is probably, I think there should be some facilitation, some enabling that is permitted to the RBI. And I would start with a repo market in corporate bonds. I think that's the place to start rather than an outright purchase of corporate paper. I think starting with repos in corporate bonds, this is, remember, something that we have been talking about for God knows how long. So this might be an opportunity to actually start the market, for the RBI to start making the market and encouraging other players to come in to encourage this market for repo market for corporate bonds. I think that's the correct place to start.
Right. And very lastly, Saugata, your view with regards to where the bond yields are concerned, taking that the extra government borrowing is something that if you have to take that into consideration, where do you see that moving?
So this is again, I mean, this question is not as bad as an FX question. I mean, which is an absolute minefield. I mean, I shouldn't even be. I'm just a poor economist. I'm not even a bond trader. So I mean, I really don't. But there are, remember, so many issues that we talked about. One is the sheer volume of market borrowings that are likely to come in. Remember, from the end April revision of the H1 borrowing program for the center, where the RBI in its press note itself estimates that additional borrowing of 4.5 lakh crores is estimated for FY21. So that's and the bond markets really didn't react too much. I mean, that kind of announcement that a 4.5 lakh crores additional borrowing beyond the 7.5, 8 lakh crores should have been enough to throw the market completely off the rails. It didn't happen. So my own sense is that markets are now expecting a certain degree. And if there are other measures that happen, some inclusion, I mean, that will take a long time. It's not going to happen quickly. But some measures to increase foreign currency portfolio flows via the BRR route or other liberalizations to measures, I have a feeling that bond markets, I mean, again, I mean, you've again seen the new benchmark cross the 6% threshold. So people are nervous. I mean, the investors are nervous. I mean, the supply of papers cannot be absorbed by the domestic banking structure. But with some, and everybody is now expecting, as we discussed before prior to this, that there is likely to be some RBI support. So given this, and given the expectations have been built up that, hey, we are going to get a CA slippage in the borrowing program, my sense is that the Reserve Bank and the government would not probably be happy seeing the benchmark, 10-year benchmark at anything beyond, hey, I mean, this is a number. I mean, I've simply no idea. I mean, there's so many moving parts in all of this. Maybe a 615, 620 with a large issuance at the borrowing program. Maybe at those levels, government will still be okay to try to test the market and see how much additional borrowings can be done. But please don't, please, you and your readership and your listenership, please do not hold me on to this. This is just an economist speaking. There's no idea.
Absolutely, this is an absolutely perspective that we're trying to gauge as well, as to understand as to what could be done right, what could be done wrong. Then what happens is something we need to see, because I'm sure even the government right now, Saugata, is pretty much in a catch-22 situation. I mean, and it's like a chicken and egg situation. You can't really catch hold of them as well with what they're doing, because if they go on one side of the table, the other side of the table is going to absolutely scream and say something else. So this is in a very different situation that we are, where everything could be right and everything could be wrong as well. So, I mean, there are no justifications that could be actually warranted for something like this. But very lastly, Saugata, from the next RBI meet, as per schedule, I know we know it's August, but if the RBI comes out in advance, anything that you're anticipating from them, I mean, what is it that you would expect them to say?
So I think, I mean, the tone of the communication will be exactly the same as the last two governors' addresses. My sense is that they will still probably June, July, August, right? August.
Correct.
So my own sense is now that sense of urgency for a mid-cycle MPC meet, I think that has probably gone. I think you'll probably see the next meet at this cycle. Any of the other measures can come in anytime soon. The one-time restructuring proposals, etc. So now again, I mean, the focus is credit. I mean, the idea is the liquidity is done. I mean, you have sufficient liquidity in the markets. That's done. So now the focus is credit. How to get credit growth up. Everybody, I mean, all of us have been talking about the need for a bad bank, which I think has been shelved for the time being. The one-time restructuring scheme for some of the bad assets, etc. Again, I mean, there are pluses and minuses, because restructuring has a predication that the cash flows going forward to be able to effectively restructure, which we do not at this point in time. So that's the key thing holding back. But I'm sure, I mean, the RBI will act to provide some, even in between. I mean, before the next policy, if it sees that credit is not improving, so there are some other measures that it will use to provide some backstops and incentives for increasing credit.
Right, and as you mentioned with regards to the bad bank as well, that has actually found some support from the RBI as well as the government as well, as per my last conversation that I had with the IBA chief. And they were clearly indicating that we've sent out our proposals. Now let's see if there is any outcome that comes on that front. Because if that step comes through as well, that will be something which will be for the betterment as well. But let's all hope for the best. Thank you, Saugata. Thank you so much for joining us. Thank you for finding the time as well. It was a pleasure speaking to you. Great insights, and we will come back to you once things improve as well. And the effects of the pandemic are slightly lower from here on.
Thank you, Hiral. I mean, this is such a privilege to be here on your show. Thank you so much for having me on your show.
Thank you so much, Saugata. See you soon. Bye-bye.